I'm constantly amazed that business owners, entrepreneurs, and even high-income earners focus almost only on making money, but few learn strategies on saving money as a wealth-building play until it's down to the wire.
Absolutely. The truth is, the top 1%, they're not just making more money, they're keeping more of what they make. So today on The Exit, we're going to be breaking down some tax advantages that smart investors use to keep more of the money they earn, both passive and active, and build lasting wealth. Now, before we jump into this episode of On the Exit, I just want to highlight there's nothing that we're sharing on here that is tax advice. We are not CPAs. We're not tax professionals. We're just entrepreneurs who would prefer to not give the government any more money than we absolutely have to. And so if you're an entrepreneur, you're building a business, you're making a lot of money, you want to, Robert Kiyosaki said it best, there's no bigger cost to your wealth building than taxes. It's the biggest expense you're going to pay is taxes. And so leveraging it was interesting. We went to a conference, Aaron and I and our team, a couple of weeks ago, and there was a lady that was talking about some of these, tax advantages she pointed out, and I can't remember the exact number, but it's like the IRS code is, 3,000 something pages, and 71 of those pages are the actual taxes themselves, the breakdown of the actual taxes themselves. The rest of them are loopholes and ways to get out of paying them. And so the IRS is literally like the tax code is literally a playbook on how to pay less money in taxes, but it's so complicated for so many people that they just would rather not dive into and exploit all of the opportunities to save on taxes. And they get mad when billionaires are paying less taxes than they are, but those billionaires are that's how they got there. Yeah. Right. That's part of how they got there is they shared less of their hard earned money with the government.
Uncle Sam.
Exactly. Uncle Sam. He's always
reaching.
He's always reaching for more. But the thing is there's literally opportunities and ways out there that you can pay less in taxes. And that's kind of what we're here to talk about on The Exit today.
Yeah. And even just, to your point of, a lot of us, we talk about these tax loopholes. Yeah. But, I think, one way to look at it is the government is actually showing us where to put our investment dollars, and then they reward us. Yeah. So if you buy real estate, or if you buy in certain economic zones, or if you invest in certain people or different areas of the economy for credits and stuff, energy stuff, there's, when you're building stuff, if you do hit certain, you can do these audits where it sometimes costs more, but then you get credit. All these things that the government wants. So it's almost like if you're the worst way to make money in the U.S. is through W-2 income. Because the government actually discourages you from doing that. And they discourage you by charging you more tax. And by having those different tax brackets, the more W-2 income you make, the more portion of it they take.
The more money you make,
you to be
the
a
more
W-2.
they take.
So in some ways, it's kind of like, you can kind of see, like, you can read it as a guide of like, oh, maybe I should go over towards these other things where I'm tax incentivized to do so because they want private investment.
Absolutely. And some recent statistics highlight that, significant tax burden is entrepreneurs and high income people face significant tax burdens. And according to the latest, most recent federal income tax data analyzed by the Tax Foundation, the top 1% of taxpayers, which are those whose AGI or adjusted gross income is like $663,000 something and above, they paid an average income tax rate of 26.1% back in 2022, which is 7 times higher than the rate faced by the bottom 50% of taxpayers. And for high-income professionals, the tax burden remains substantial here in 2025. Single filers with incomes over $626,000 and married couples filing jointly with incomes over $750,000, it's like $751,000, $600,000, will face the top marginal tax rate of 37%, which means the more money you make, it's almost like you become unincentivized to get past a certain point unless you understand advanced tax strategies. Because what these statistics demonstrate is that entrepreneurs and high income earners continue to shoulder a disproportionate share of the overall national tax burden. But it's important to note that there are a lot of strategies out there that are available to help mitigate this tax impact. Maximizing deductions, utilizing tax advantage investment vehicles, and engaging in different strategic tax planning. And so
Yeah.
as we kind of jump in here, I want to lightning round again. Consult your CPA, but here are 8 different advanced tax strategies that you should be paying attention to, and you should be talking to your CPA and your tax people about as to whether they apply to you and whether they would help you. And I'm just going to hit these lightning round, but then we're going to go back and we're going to talk about a few of those that we personally employ regularly and kind of the impact that that's had on overall tax burden. So number 1 in the 8 advanced tax strategies is cost segregation that's available for real estate investments. If you own a commercial or rental property, a cost segregation study can accelerate depreciation deductions. And what a cost seg study is it basically is a third party that comes in and separates out all of the real property from the personal property, right? So fixtures and lights, and there's even some cost seg analysts that will depreciate certain non-load bearing walls in a structure, right? Things that can be classified as personal property. And those, that when you segregate that out, the portion of it that is personal property can be depreciated on a much more accelerated time frame, whereas the real property typically can only be accelerated over a 27.5-year period. It's called macros depreciation. And so that's one way is cost segregation study. Number 2 is investments in opportunity zones. Now, there's a lot of nuance to this, so you'll really want to dig in and understand it if you choose this as a tax strategy, and definitely talk to a tax advisor and attorney about this stuff. But if you invest capital gains, for example, that you achieve in 1 year into a qualified opportunity zone or qualified opportunity fund, then you can potentially defer all of those capital gains taxes, and that money can grow tax-free after 10 years. So if you hold that property and reinvest into that property in a qualified opportunity zone or qualified opportunity fund, then you could essentially pay 0 tax on the gains. And a third one that's not a lot of people understand, because most of the time it's applied in the tech industry, and that's R&D tax credits. Businesses that develop new products, new processes, new software, they can actually claim research and development tax credits, which reduce tax liability dollar for dollar. Right, up to 10 to 15% of qualifying R&D expenses can be credited back dollar for dollar. So it's not a deduction in tax basis. It's an actual credit that dollar for dollar reduces the amount of tax you actually pay. This can be also used to offset payroll taxes for certain qualified small businesses with under $5 million in revenue, or businesses that are in the first 5 years of operation. And then there's also provisions for being able to carry that forward. So if you don't use it in 1 year, you can carry it forward and use that credit the next year. And kind of things that qualify for that typically are the development of new products, new formulas, new software, maybe improving manufacturing processes, making them faster, cheaper, more environmentally friendly, prototyping, testing, developing new equipment, hiring engineers, scientists, or software developers. Some of those expenses can be considered R&D, and you can get tax credits back for that, and improving existing products to enhance performance, efficiency.
I need to hire some scientists.
Yeah, we almost hired a rocket scientist. Yeah. Chad, I hope you're listening, man. We still want to hire you one day, hopefully.
Yeah,
but
soon.
Yeah, absolutely. We got a good friend. He was actually on the episode. He's a rocket scientist, worked for Boeing Rocketdyne, and came real close to striking a deal, having him come work for our company, but it didn't work out. Timing wasn't right. But another of the 8, so we've done 3. The other one of the 8 is self-directed retirement accounts. So that's solo 401ks or self-directed IRAs. This kind of allows an entrepreneur, business owner to invest in real estate or private equity or other kind of non-traditional assets and be able to defer taxes, paying taxes on those investments and on those gains. Another one is investing in oil and gas, which is something we do, and we're going to talk a little bit about it here in a minute. There are intangible drilling costs, there's depletion, there's depreciation, and the tangible and intangible drilling costs are actual costs that reduce your overall tax bill, and they're not recaptured later. Depreciation, accelerated depreciation, they kind of reduce the basis of your investment. So at some point when you sell that asset, or when that asset, if it's a syndication, when that asset sells, then you're going to recapture that, and you'll need to roll it over via 1031 exchange, or roll it over into something else that kind of washes it out with new accelerated depreciation. There's ways that you can continue to snowball that and avoid paying tax on at least most of the gains. But with oil and gas investments, the IDCs and the TDCs, intangible drilling costs and tangible drilling costs, those are actual hard costs that reduce it permanently, so they don't get recaptured. And so the next one is 1031 exchanges. I mentioned that if you sell, a property, typically you're going to have to pay capital gains on that in the year that you sell it. But if you do it as a qualified 1031 exchange and you roll that over into another property, then you can defer those taxes and continue to kick the tax man down the road. And a lot of people use this strategy long term. They'll continue to roll over and roll over and roll over until they die and their kids inherit it and get a step up cost basis, which means the tax never gets paid on any of that lifetime worth of gains of rolling those 1031 exchanges. And then there's some estate freezing techniques, GRATs or IDGTs. Grantor retained annuity trust or intentionally defective grantor trusts, which help you to transfer assets with minimal estate tax impact. And so again, talk about some of these things with your tax advisor. And then number 8 is income splitting via family trusts. If you, for example, let's say you make $1 million, a year, you can take that and your tax, basis for that would be 37%. But if you had that money, split up and paid, you make $250,000, your spouse $250,000, 2 of your kids $250,000, whatever, and you put it all kind of in a family trust, then each one of those, as long as they don't have additional income that brings them to a higher tax bracket, you're paying more of like a 24% tax instead of the 37% tax, right? Because you're splitting the income across multiple people via, through income splitting via family trust. So those are kind of the 8 that I just wanted to quickly pound out. That was a marathon.
You guys have to listen to that again on half speed.
Absolutely. Talk to your tax professional about those things. But Aaron, let's talk a little bit about, some of the stuff that we do right now. And then we also provide entrepreneurs with these, with some of these options in our multifamily and alternative investment platform, OakIQ Investments, multifamily syndications.
Yes.
How do we get investors tax benefits, tax deductions through investing in a multifamily syndication?
Yeah, I mean, so one of the things Caleb mentioned was the bonus depreciation. I mean, those passive losses, it's a paper loss. It's, basically as, normal residential real estate is depreciated across, 27 and a half years for the improvements. The land is not able to be depreciated because it's land. But so usually we'll do 5 to 10% for the land. So if you have a $10 million apartment complex, about $9 million of it will be the improvements. You usually see that on your tax bill too. You'll see land and improvements, and it'll be broken down on your assessment. But yeah, it's basically crunching all of it into a much shorter time frame. So instead of depreciating the entire $9 million spread across 27 and a half years, whatever the math is on that, you're bringing it all into, a lot of it into year 1 or years 1 to 5. So you can get a big tax write-off basically in year 1.
Yeah. So someone invests in, say one of our multifamily opportunities. We're going to do a cost segregation study on every asset that we buy or build. Right. And what that's going to do is what I said before, it's going to separate out real property improvements and personal property. And there's a big chunk of that. Like one of the deals we've got right now, it's like 1.8 million that can be depreciated in year 1 off of that asset. And so that's somewhere to the tune of 40 to 50%. When an investor, invests, they're going to get like a 40 to 50% paper loss on their investment amount in year 1. Which means they're not going to pay taxes on that money. So if they have gains somewhere else and they invested here, they're basically cutting their tax bill in half just by taking, selling one investment and moving it over into another, investment. So
yeah, you can use it to offset
other gains. Yeah, other gains.
And if you don't have any, it'll just carry forward until you sell the asset, the existing one, the apartment complex, because then you'll have to have recapture. But I'm always for kicking the can down the road. So the recapture is a reality. But 5 years from now, or that's always been my approach. Is even if I can defer things by a year, I'm all for that.
Yeah, and this is having a big impact. I mean, people don't understand that the ability to take bonus depreciation, which was part of the initial Trump tax cuts back in 2017. accomplished a lot in encouraging more and more people to participate in alternative investments like real estate versus just kind of the traditional, put some money in mutual funds and just wait 40 years and hopefully you've got enough money to retire kind of strategy. It's take advantage of like the benefits now while you're also growing your wealth for the long term. And there's been, an increase of like more than 15% participation from investors in these kind of investments, since the implementation of that. So that's, that represents billions of dollars that have flown in, that have, which lifts, lifts it for everybody. So it's, it's really
incentivizing to do that.
Entrepreneurs specifically should be paying attention to.
We just got some K1s out for this one property, LeGrand, and it was 600. It was 600 or 700,000.
Yeah.
So it's like awesome.
Yeah. Cause it's like a less than $3 million property.
Or one investor, I guess.
Yeah.
And then our team, Oak IQ, and a single check writer. So he's getting a chunk, which is awesome because he actually had to sell something to go into this deal that he's going to now have to get hit with the tax bill, but this will wipe it out, or most of it, or I don't know the exact situation, but it's awesome. But I would always also say to a lot of people I've seen this where people get too fixated on trying to save on taxes, where they do like kind of weird 1031s that like into something that's kind of like, it's like, well, sometimes it's better to just like take the hit and then just like make more money.
Yeah.
So, and then it resets your basis too, but it's all just part of like what you because a 1031 can be sometimes kind of hard just because of the timing. We've got actually that one investor we have he texted me yesterday. He has an apartment building he's selling. It's picking up.
Yeah.
So I'm supposed to call him, and he wants to do an exchange. But from the date that thing closes, his down leg, he has 45 days to identify a replacement property and 180 days to close. The 180 days to close isn't the hard part, but it's the 45 days, that you got to make sure.
Identify. You got to know.
So you got to start
looking
into. And have those two pieces coming together. And we've done them a few times and stuff like that. But yeah, I mean, there's a few hoops to jump through.
I had a conversation with a lady who wanted to do a 1031 exchange, and she sold a house. It was only like $200,000 in actual equity that she walked away with from that. She had some debt on it, and she wanted to do a 1031 exchange to avoid, paying, $40,000, $40,000 in taxes.
Yeah.
But the problem was that she was under the gun. She had like 3 days to identify because she just hadn't been able to land something. So she ends up going into something that was not like
losing investment.
She's losing money. It's like to save 30 or 40,000, you just cost yourself 100,000, right? And so understanding with 1031 exchanges, they are a valuable tax tool.
Yeah.
We like them, we've used them, but don't get so fixated on, I got a 1031 exchange this thing. There are other ways to be able to reduce that tax liability, such as going into, a syndication where you're getting year one bonus depreciation that'll wipe out a portion of that and could potentially be a more lucrative investment. So you just got to kind of do side-by-side comparisons. Of like, if I do this through 1031 exchange, what kind of asset am I going to be able to get into? What kind of return on investment is that going to give me? Am I going to end up actually netting more money by doing the exchange, or by paying a portion of the, of the capital gains and getting some other tax, benefits somewhere else? But I'm going to be in an investment vehicle that's going to actually grow faster, and I'm going to actually make more money in the long run. And so it's important to not get fixated on one tax strategy and just say, this is the only thing I'm trying to do, because there are other ways to, there's more than one way to skin a cat, right? There's more than one. Like we said before, there's 3,000 something pages.
There's 8 ways to skin a cat.
Yeah, exactly. Those are the 8 that we're talking about, right? But there's, 3,000 plus pages in the tax code that actually, benefit, like that are opportunities for you to figure out how to not pay that tax. So don't just get fixated on one strategy is the point that we're trying to make here.
And CPAs are specialized. They're not all created equal, similar to attorneys. There's attorneys, we've probably got like 5 or 6 attorneys that we've worked with that are in different areas of expertise. And it's the same for accountants. You would think that they're all kind of the same, following the tax code, but they're not though. They specialize in different things.
Yeah.
And so that's just something to if you're
and they have different positions, different perspectives, different interpretations of the tax code. So it is important to have a CPA that's forward thinking, but that you agree with their philosophy for how they're interpreting the tax code, right? And they align with what you're, with your, tax goals and tax strategies. And so another thing that, Aaron and I are, that we're focused a lot on investing in is oil and gas. We see a really great opportunity in that. In fact, we've got an oil and gas fund that we've put together that investors are currently investing in to go and, participate in acquiring 700 existing producing wells that are already cash flowing about $25 million a year, producing, 4,500 barrels with new drilling opportunities already permitted and all that kind of stuff. But the reason this is so appealing is because of the idea of creating passive income, substantial passive cash flow in a way that is extremely tax efficient. And so by being able, taking money, investing it into these, oil and gas funds, we are able to take intangible drilling costs, first year tax deductions, depletion, depreciation, and essentially the cash flow, the target and the mandate of our investment thesis in oil and gas is that we would be producing a high income cash flow for ourselves, for our investors, for anyone who's participating, while also offsetting the vast majority, if not all of those gains with those tax benefits so that your overall net return is much higher. Right. So we've been doing this type of investing for a little over 2 years, actively investing in it and having a couple of funds in that space. And right now we're paying investors over 15% return and in cash flow, right? Just 15% distributions of cash flow. So that they, invest $1 million, they're making $150,000 a year just in cash flow.
Yeah.
But the added benefit of that is that $150,000 that they're making is being offset by intangible drilling costs, depletion, and depreciation to where they're paying very little, or maybe even in some cases no taxes on that income. Yeah. And if you're in a 37% tax bracket, that's basically saying I'm making $150,000 plus another 37%, right? So it's like another almost $50,000 on top of that, right?
Yeah, because you just get a share. If you're in a fund, that raises $10 million and you throw in $1 million, then you just get 10% of the depreciation and losses and everything that come out of that fund.
Yeah, absolutely.
As a 10% owner in the fund.
Yeah,
and so it's all pro
they're
rata.
all passing through, and that's how we kind of structure it. Yeah, and so it's an interesting conversation. I think the big takeaway for those of you who are listening here is ultimately, investing in tax efficient vehicles can not only make the income from the investments be less burdened by taxes or even eliminated, but it also, those investments can offset other gains and other income. Talk to qualified tax professionals, have multiple conversations and ask them about these things and ask them how they could apply to your situation. Go back and, listen. We'll put it in the show notes. The 8, kind of advanced tax strategies that we mentioned at the top of the show so that you can go and talk to your CPA about it and ask them, hey, would this apply to my situation? How much could I save in taxes for doing these things? And we're going to be talking a lot more about this here, very soon. We're going to be doing a masterclass on advanced tax strategies where we're going to be bringing in, some other people who are very, very proficient in these things. And so if you're interested in participating in that, just go ahead and email us at info@oakiq.com. Let us know you want to, get in on that, and we'd be happy to send you. It's going to be a free masterclass, so we're not trying to sell you anything, and we're not trying to make money off of you. It's just a way to add value to our community of listeners. So, Aaron, you got anything else that you want to wrap up the episode with?
No, I mean, I think the only thing I would say is just kind of going along with once I started making a lot of money from, because I've had different seasons of life, right, where I was, not making a lot and then making more. And I was worried almost to make more money because of the taxes.
Yeah.
But I think that's something
it's a real thing.
You do have to just kind of forget about that though, and just make as much money as you possibly can, and and then do this along with it, you know? So I think it's kind of both, right? Like it's like, you know, that's kind of the joke is like, we'll just make more money to cover the tax bill, right?
Right.
But I think it's doing both of these things together, being smart, being, you know, like you were saying, there might be ways to actually not have to do that extra work by just being smarter, and don't wait until it's, you know, March and you get all your K1s and all your stuff to even start doing tax planning way before that.
Yeah.
You know, and start thinking ahead. And so, yeah, those are my thoughts.
Yeah, absolutely. All right. Thanks, everybody. Remember, stop trading time for money. Start making your money work for you. Most importantly, keep more of what you make. Don't give it to the government. We'll see you on the next episode of On the Exit.
See you guys.